Symbotic and Rivian both reported earnings recently. The calls gave me the impression that both of these companies are progressing nicely and they're positioning themselves to generate high returns over the long term. Now, these two companies are kind of like the little brothers to my largest holdings, which are Amazon and Tesla. Those are probably my highest conviction stocks. They definitely are. Rivian is a little brother to Tesla, Symbotic to Amazon. Tesla and Rivian, they obviously both make electric vehicles. Amazon and Symbotic, they have a lot of similarities. They're both involved in warehouse automation, logistics, supply chains. So while, with Tesla and Amazon, you have more mature, older, and established companies that through the many videos I've made, I've outlined the reasons why they're going to continue to dominate and outperform the market over the next decade. But in the case of Rivian and Symbotic, you have these younger prodigies with the potential for higher returns at the cost of higher risk due to a shorter track record, and neither of the companies reaching profitability yet. But I think that they're on pace to get there. But these young companies definitely have tremendous backings, right? In the case of Symbotic, they have heavy investments from the likes of both Walmart and SoftBank. And in the case of Rivian, Amazon is actually the largest shareholder, as you can see, with 16% ownership of Rivian as of the end of March. Amazon owns 16% of the company, Vanguard 7%, T. Rowe Price 6%, and so on. But by a long shot, Amazon is the biggest shareholder. They own quite a bit of Rivian, and I think they're going to do, what they can, what they need to see their investment do well. But we'll get to more on that and the whole partnership that they've got going on. But let's start with Rivian's quarter here. They just reported. So Rivian's R1S, the SUV, was the best-selling EV in the U.S. over $70,000. Now, I don't think this is not really a particularly useful metric, as the market is very limited at that price. We'll look at what is important, though. What is important is that they got 5.1% market share for the US EV market for the first quarter. Now, you see in the list here, Rivian is the only name seeing its EV market share actually trending up. So Tesla remains the leader by a long shot with 52% market share, and their market share has obviously declined quite a bit from 74% to 52% over the course of the last 2 years. And bears will look to Tesla's declining market share as, the end of the world for the company. The reality is, when you have 100% of a market, you can only lose share. But the point is, they're going to keep and dominate a significant portion over the long run, I believe. And I think the best way in the case of Tesla, to benchmark their sales is really against Apple iPhones, because, iPhones, I think it's just, this is the way the technology is moving. It's the most similar comparison. It's a better way to compare than to cars, because we're basically getting these technology computers on wheels here. So you look at Apple iPhones, they have 52% market share in the US. It's right where Tesla is right now, although I'm sure Tesla's, market share will decline a little more. But they don't need 52%. They could have 20% of the market share and do just fine. Again, especially when the comparison here shouldn't be amongst EVs. It's EV versus ICE, right? There's a massive gas, market. EVs have probably only penetrated 6%, less than 10% for sure of the market, the total car market. So these numbers are largely irrelevant. But, just for today's purposes with the EVs specifically, Apple has 52% market share of iPhones in the US, or of the smartphone market, and they have maybe 20% of the smartphone market globally. I'm kind of thinking we're going to see a similar path for Tesla, right? Where if they could get 20% of the global car market, I mean, that'd be really good. But, so that's Tesla's whole decline. Like, it's probably going to keep going down. But the point is, they're light years ahead of everyone else. Nobody's catching up. But Rivian, I liked seeing here the fact that Rivian is actually one of the only, if not the only, name on this list that actually is seeing its market share steadily increase. So, we go back 2 years, they had 0.7% market share. Last year for Q1, 3.1%. Now it's up to 5.1%. That's what you want to see. I mean, they're steadily, incrementally increasing. They're doing it in a sustainable way, whereas a lot of these other companies have just been all over the place. I mean, General Motors, Ford, I mean, they did well. They got up to 9%, 8%, but now they're back down 7.5% and 6%. They're kind of all over, and they're one of the better ones here. Hyundai is doing great. I mean, they're staying pretty consistent, 8.5% share as of Q1. Everybody else, it doesn't even matter. The rest are really irrelevant. Maybe Toyota, they're a great company. They'll definitely get those numbers up. But the point is the market is big enough for multiple companies, just like the regular auto market was. But I think Rivian is really in a great position. Tesla and Rivian both are my two picks if I wanted to for the EV market here. Now, I also think that a lot of the reason why you're even seeing success at all from a lot of these legacy players, specifically like General Motors and Ford, is because we had that $7,500 tax incentive to buy an EV. And I think it was yet another bailout for the legacy auto companies, cleverly disguised, but it was mainly to benefit the likes of Ford, GM, and the legacy, American players, because we just continue to bail these companies out. The banks, airlines, automakers, we bail them out time and time again at the expense of innovative companies that actually do something useful and, innovate and improve the technology in our lives. Explain that to me, please. But again, the point is, I think Rivian is probably the second best positioned company here after Tesla because they don't have a legacy gas car business they need to unwind. So that's huge too. But just to see that they're, all that considered and they're steadily increasing their market share, great signs. Okay. So obviously the R1S, best selling car in that category, contributed to this 5.1% market share. The R1S was actually the fourth best selling EV in the US during Q1, and it was the best selling large luxury SUV in California across both electric and gas vehicles. So this proves my point. When we look at the full picture, the electric car market is less than 10% of the total picture. But the fact that they had the best selling car across electric and gas in California, I mean, they tend to be ahead of the curve. What happens there is probably going to follow for the rest of the country. They're competitive, they're competing and outcompeting, electric and gas cars. So I think they're in a great spot. Rivian's doing great. And their market share fifth highest, right behind, Tesla, Kia, Ford, and General Motors are ahead of them. But like I said, I think the only real comparison there is Tesla, which it's obviously a very distant second place, but the rest of these companies have all kinds of problems with having to unwind a gas car business. But again, I'm reassured seeing, Rivian steadily increasing the market share. Now, the thing that really drew me to Rivian initially, what got me interested in investing in the company was the whole Rivian and Amazon partnership. They have a goal of bringing 100,000 Rivian electric delivery vans to the road. And that was the main part of the business that attracted me to begin with, because nobody else back then was focusing on the commercial segment. And you know what? They're still not. Nobody else is making electric delivery vans. And I expect to see other companies make deals with Rivian to electrify their fleets as well. You're already seeing it start. There was some talk. AT&T was looking to electrify their fleet. I think you're going to see more of that follow. Companies will have to turn to Rivian. Now, on the profitability front, the company's progressing and they expect to deliver a positive gross profit in Q4 of this year. They're moving in the right direction. Their loss per vehicle for this quarter actually came in just under $39,000, which was down significantly year over year. Last year, it was $67,000 for the first quarter, a $67,000 loss per vehicle. They cut it in half. So they're definitely trending in the right direction. And it was also down sequentially. Q4 2023, they lost $43,000 per vehicle. So we're getting there. And again, maybe Q4, you see a positive gross profit, definitely trending in the right direction. And they highlighted some of their cost saving measures. I'll pull up here. So by adjusting the way they're going to do the R2 production, they're estimating over $2 billion of savings by doing it at the plant in Normal, Illinois. That's projected to start first half of 2026. They also got this huge $827 million incentive package from the state of Illinois. So the company just continues to optimize. Another one of the big examples of, getting closer to profitability, progressing in the right direction here, was the fact that they did this retooling this last quarter for the R1 manufacturing line. They retooled the factory and they're projecting that their manufacturing will now be 30% more efficient on the R1. So that's huge, right? Obviously moving in the right direction toward profitability and just getting, much more efficient and optimized. Now, as you see here, year over year, we're painting a really nice picture too, with revenue and the deliveries doubling. Revenue is up from 661 million to 1.2 billion for the first quarter of 2023. Deliveries up from 7,900 to 13,500. So that's all moving in the right direction, but they're burning cash still. Negative 1.5 billion of free cash flow, as opposed to negative 1.8 billion a year ago. And, they are running a little low on cash here. They're down to $7.8 billion in cash. That's a little bit more than 5 quarters, maybe 6 quarters that they're covered. But again, I'm sure that they're going to, these numbers will continue to improve. It'll buy them more time. They've got Amazon to help them out. I think they're going to be okay. And if they can just stave off bankruptcy over the next like year and a half, I think that they're in the clear. They're golden, right? Once rates start coming down, people will start buying cars again. And Rivian will do very well, I think, long term. And with all these processes, like I mentioned, 30% more efficient, they're going to drive down the cost. The losses should continue to decline, and that will also help tremendously. So Rivian also stayed on the call. They expect the entire EV industry is going to electrify despite short-term setbacks. And I think they can carve out a sizable chunk of this new market long term. Short-term things should start to improve. If we see rate cuts soon, which the auto industry awaits with bated breath, they need it, right? It's very hard to buy a car when it costs the equivalent to a home mortgage on your monthly payment. So I'll be keeping my eyes on how these optimizations translate to the bottom line in the coming quarters. And with the backing of Amazon, Rivian should be able to weather, any short-term collapse in demand for EVs that we're seeing or may continue to see. Long term, I think there's plenty of room for both Tesla and Rivian to succeed as market leaders, thanks to their vertical integration, their technology-focused approach to this rapidly changing auto market landscape. At the end of the day, I think this market's going to look very different in 5 years, 10 years than it does today. So that wraps up for Rivian, and then on to Symbotic real quick. So the warehouse automation company, Symbotic, I've made a ton of videos on it. If you're not familiar with the company, they announced they're going to begin recognizing green box revenue. So this whole green box initiative is to kind of bring their warehouse automation tech to smaller companies. They've only served big box retailers so far. That might open it up to a whole new market. Maybe you get a bunch of small companies that are able to share one warehouse, making it much more accessible and a huge market opportunity. So they announced that they're going to begin recognizing green box revenue in Q3. This is a joint venture with SoftBank, by the way, too. Their first customer is going to be C&S Wholesale Grocers. Now, C&S is also owned by Rick Cohen, who is also the CEO of Symbotic. We'll touch on that in a second here. So the company reiterated they believe over time, gross margins can reach 60% as a growing portion of their revenue starts to come from software and maintenance subscription revenue as they complete these system build-outs. And then just to give you an idea, this chart shows their system build-outs. The amount of time it's taking them to complete the installations is greatly improving. They're able to do it in as little as 9 months now, almost half the time it took to build one system, 2 years ago. So as these systems get online, faster and more of them, they've got 18 that are fully operational now. They're starting to collect a growing amount of software and maintenance, subscription type revenue, which is going to bring these high margins. And that's really where the cash cow is for this company over the long term here. So this is all great to see. They've got a bunch of innovative systems they're working on. One is called BreakPack, which essentially enables companies to retrieve individual items and pack them all together in a facility. Instead of, historically with automation, it's been very hard to do that. You're only working with all of the same type of item. The technology just wasn't there yet. But so now, you can break down these product cases into individual units and then combine them to make a mixed SKU or a stock keeping unit, mixed SKU carton. So BreakPack, it can automate this process of sorting goods. Say you had an order, you needed to get one shampoo bottle, one roll of paper towels, and five other different items that all need to be shipped together. So this process of organizing the mixed items together has proved very challenging to automate historically here, but Symbotic claims they can do it, and they're looking at their second customer for BreakPack. Now, they also began testing with perishable items. So far, they only operate in ambient environments. And after that, they're hoping to tackle frozen environments, which these would be huge, opportunities. Rick Cohen on the call was talking about how an ambient building or a warehouse for non-perishable items, it may only cost $100 a foot, but perishable might cost $250 a foot. Frozen might cost $350 a foot. So, there's a huge opportunity here. This would enable Symbotic to command much higher prices. They just got to make sure the robots can operate in these colder environments. So to finish up here, we'll look at here's some of what I think are some of the important metrics for the company. You can see they're growing nicely. Revenue is up 50% this quarter. That's basically what they had guided for, up 50% over last year. It's very hard to grow revenue 50% when the last year you grew at 177%. So very impressive. Even though the growth rate is slowing down, it's still really high. I mean, I think it will continue to go down. But they did say they think revenue is going to reaccelerate in the second half of the year. I'll touch on that in a second. But they've doubled the amount of fully operational systems year over year. We went from 9 to 18. So again, these 18 systems to start showing a lot of that software and operations maintenance type revenue, which is going to start boosting margins. I mean, they've got 37 deployments in progress. Once those are up, I mean, you're looking at a lot more higher margin income, and they're building them faster, as I said in the last chart. So in conclusion, the little arrangement between Symbotic and CNS with the green box deal, where Rick Cohen is essentially selling the product to himself, not the greatest optics. I'm seeing a lot of people who are a little skeptical of that. But could it be a way to prove the technology and as the first use case to get other companies interested? I think that's also possible, but I'm not arguing. Like, I think it doesn't look great. But aside from that, Symbotic continues to seem like a great company with really innovative technology. They just have a less than ideally behaving stock, and there's also been a lot more insider selling than buying recently. So these are the things I'm kind of keeping my eyes on. There seems to be no shortage of opportunity, though, for the warehouse automation, industry and for Symbotic. Again, as they look to move into maybe non-ambient and colder warehouses next, that's a large opportunity. It will keep expanding their total addressable market. And like I said, they are thinking that revenue growth is going to reaccelerate in the second half of 2024. So I'll be keeping my eyes on news regarding, new customers for Greenbox, how BreakPack is going, and if this insider selling continues. But let me know what you guys think of these companies down in the comments below. And if you guys enjoyed the video, don't forget to like and subscribe. And if you're interested in joining our community where I share all my stock and options trades, we're doing weekly Zoom calls. Sign up for my Substack in the description below. There's a link. You can sign up for the Substack, read my articles for free, and then there's a paid tier for community access. This is Vinny from the Investment Club. I'll see you guys next time.